Let's begin this chapter by discussing what a merchandiser is. A merchandiser buys and sells goods. It does not provide any services. So far in this course, we have been preparing journal entries under the assumption that they are providing a service. We will look at the exact same types of transactions, such as making a sale and collecting payment, but for a merchandising company instead of a service company. Manufacturing companies actually make the goods. We will not look at manufacturer entries until accounting 2. For now, we will look at transactions for merchandisers, which would either be a wholesaler or a retailer. A wholesaler buys goods from manufacturers and sells to retailers. Retailers sell the goods directly to the customers, which would be you and me. We will complete transactions for purchasing goods from either the manufacturer or wholesaler, and then selling the goods to either a retailer or to the customer. Basically, transactions for this blue box here, either the wholesaler or retailer, it won't make a difference when we do the journal entries. There are two new concepts to discuss right away. First is operating expenses. These are the expenses to run or operate the business. This includes selling and administrative expenses. The other concept is a new account called cost of goods sold. Cost of goods sold was something that I initially struggled with when learning accounting, but it's actually a very simple concept. All cost of goods sold is the cost of the merchandise or inventory that the business sold. It is an expense account. For example, if I purchased a box of keychains for $100 and then resold them for $300, my cost of goods sold would be how much I spent on them, which was only $100. When I purchased the keychains, I have an asset on my books, yet the business did spend money to make that purchase. We will learn that inventory is an asset when we make the purchase and will be expensed when we sell it using the cost of goods sold account. You are used to calculating net income for a service company, which is revenues less expenses. Net income is still the same for a merchandiser, revenues less expenses. However, we format this a little differently. We still begin with revenues, but instead of subtracting all expenses, we first only subtract one expense, which is cost of goods sold. This gives us our gross profit. Then we subtract the rest of the operating expenses to arrive at net income. Here I have a very basic example of an income statement for a merchandiser. We will cover this in more detail in our last topic for this chapter. As you can see, revenues are the same amount and net income is the same. Just because we are formatting it differently does not mean that net income changes, because it does not. Instead of grouping all the expenses together, we pull cost of goods sold out of that group and subtract it on its own to arrive at gross profit. Then we continue with the rest. Gross profit is an important indicator for merchandise companies. You want it to be as high as possible. The operating cycle of a merchandise company begins with purchasing inventory and ends with collecting cash from customers. Here is a layout of the flow of inventory. You begin with beginning inventory. This would be any inventory that was unsold from the prior time period. You also make purchases of new inventory during the period. The total of new inventory purchased and old unsold inventory is your merchandise available for sale. This is what we had available to sell during the period. Now, you either sell it or you don't. If you don't sell it, then it stays in your inventory. It will be your ending inventory amount. This will also be the beginning inventory amount for the next time period. For example, if I had 10 shirts that were unsold this month, then my ending inventory will be those 10 shirts. Next month, my beginning inventory will be those 10 shirts. The ones that we do sell become part of cost of goods sold. We can expense the amount we spent on these shirts, on our income statement. Our last slide for this topic is on the inventory systems. There are two inventory systems. The first is the perpetual inventory system. This is when we update accounting records for each purchase and sale of merchandise. This is continuous, and every sale there is an accounting entry. This system used to be used only for companies selling large or expensive items. However, with new technologies such as the use of scanners, the use of this system has increased. The second system is the periodic inventory system. This is when accounting records for the purchase and sale of merchandise is done only at the end of the accounting period. For this chapter, we will be looking at transactions mostly under the perpetual inventory system.